Yo guys, good morning. Good to be back. Today is September 2nd, Wednesday, 2 days into Spice-tember. Today we're going to talk about a topic that I think answers many questions that new investors have. No, not when moon, but how should I start investing? And that's always a hard question because everyone's situation is different. Different capital, different income. So the topic we're going to talk about today is dedicated cost averaging, or DCA. The reason I like this topic, and the reason I think it's especially valuable for new people, is it's simple, it's effective, and it can work for anyone in any situation. So, dedicated cost averaging. What does that mean? Well, before you even start to attempt to DCA, first you need to take a look at your financial situation. You need to have a grasp over your income versus your bills or your outcome. I don't know. You need to see how much money after every paycheck do you have left over after you've taken care of every expense in your life. I would akin this to dieting, as I've done in the past. Dieting is a dangerous word. Nobody likes to hear the word dieting. But just like dieting, DCA is misunderstood, or budgeting is misunderstood. Budgeting isn't a focus on denying yourself things. It's not a focus of cutting things out or not doing the things you enjoy. Budgeting is simply keeping track of where your money is going, how much is going out, and how much is coming in. So my little tips on budgeting would be find every expense in your life. Maybe you have to go through your bank statements, figure out how much you spend on each category. Like for me, $1,000 for rent. I factor in maybe $200 a month for alcohol. Round up. Round all those numbers up. See what you're left with. Whatever you're left with is the amount that you could potentially invest. I would also recommend factoring in savings, adding to your savings every month, contributions to your employer, benefits program, etc. And only after you have a grasp of what's coming in and what's going out can you see what you could potentially invest. Rounding up helps because you're less likely to mess your budget up then. So once you have that, you have the number that you could potentially use to dedicated cost average. So dedicated cost average is very simple. All you do is you find that amount that you're willing to invest. People say that you should invest an amount you're willing to lose, and I think that's great advice. I think it puts you in the right mindset. So after that, you just need to pick how much monthly or weekly. It really doesn't matter. The important part is you're going to pick an amount and a regular interval, and they're both going to be fixed. So I'm going to just use a random example. Say I have $100 a week extra after everything is taken care of. This $100 is free for me to invest or do whatever with. I'm not depending on that money. And I choose to do $100, and I choose my interval as a week. What that means is every week at a fixed time and day, so maybe Monday at 8 a.m., it really doesn't matter. The only importance is that it's fixed and you don't change it. What I would do is every Monday at 8 a.m. then, I would make a buy into whatever asset. Doesn't have to be Bitcoin, doesn't have to be anything. This works across the board. I would make a fixed buy at the same time of the same amount. So every weekly candle, I would be making the same purchase, up or down. And over time, my position would be built as an average of the price action that I've seen during that time. So let's do a little example. If you started at the very top, okay, this isn't going to work. Cool. If you started DCAing at the very top of Bitcoin in December 18th, 2017, the worst possible time, right? Your first buy, let's just say you got really unlucky. Your first buy would be at 20,000. That'd be very scary. Probably lots of emotions there. But your next buy, let's say, would be at 14, then at 16, then at 13. And so over time, you would be buying lower and lower, and you're buying regardless of the price action, just in the set intervals and the set amounts. Over time, your cost average would come down if price continued to sell off as it did. It's easy to look back and say this, but you wouldn't know at the time. Your price would continue to come down until eventually price will rally in almost any asset. This is just historically successful on everything. Over time, things go up. If you had continued doing that every week till today, your average cost per coin would be right around here in the 7,000 area. So you started at 20, you got wrecked. You jumped in on the FOMO. You didn't go all in like many people did and really, really got wrecked. You just kept buying at the same interval with the same amount. And now, is it 2 years later, your average cost is about 7,000. You might say that's not the best, not the worst, but you're up 52% now. You did nothing. You didn't know anything about trading. You didn't do any TA. You didn't do any risky trades. You didn't even have to watch charts. You didn't even have to know what the price is. You just set it and forget it. There's no emotion in DCA. That's what I really like about it for new people. There's no emotion. If it goes down, it's almost a good thing. It's going down and now you get to buy more. And you're buying at a cheaper price, which always feels good. And so what you're doing is you're accumulating a position over time. You're removing all emotions from it. You're removing all knowledge. You're removing all potential mistakes that you might have made along the way that would put your cost average higher. And so this is a strategy that has been used for a long time. If you are US, or if you have I guess other countries also have contributions in their employment for retirement. Essentially, a 401k is just dedicated cost averaging. Every paycheck you're putting the same amount. I guess that does fluctuate, but you're putting an amount into your investment on a fixed time schedule at a fixed interval. So it's really the same thing. There's definitely nuances there, not important, that do make them a little different, but it's the same concept. It's the fixed interval and the fixed amount. So you'd think there'd be more to this, but there really isn't. That's dedicated cost averaging. It's highly successful historically. Not financial advice, and past performance is not guaranteed future performance. But so far in the history of almost everything, if you pick something that you're passionate about and you commit to dedicated cost averaging, statistically you do well. Statistically you do infinitely better than most traders. I think one important thing about DCA that doesn't usually come to mind right away is you don't want to put every penny you have extra into DCA. That's definitely tempting because you're feeling a rush. You got to get in. You're not doing it fast enough. DCA is about going slow. And the reason for that is because one of the most important factors is that you can continue to do it. If you started here at 20,000 and you overburdened yourself on your budget, you can't actually afford it, you lied to yourself, and you buy, price keeps going down, and now all of a sudden you're like, man, I can't afford this, I'm going to stop. Now your cost average is crap. In this scenario where you started at 20K, now it's you're maybe 13,000, 14,000. Instead of being up 50%, now you're down 21 to 25%. There's a lot of temptation to tweak your cost DCA, and I think that there's an argument for that. It can be done, and I think there is ways to build on how successful this is. But in general, keep it simple. KISS. Keep it simple, stupid. The whole point is that you're not investing a lot of time and emotion and effort into this, and you're statistically doing well. There's a lot of people here that I bet wish had a 7,000 range coin average. And this person in this scenario started at the worst time, did nothing special. They could have set up a reoccurring buy on an exchange, and now they'd be in a good position. It helps you avoid overextending yourself, which leads to emotions in trades, which leads to bad trades. So that's why I think that this is a really great strategy, even if it's not for you. It's a great strategy to be aware of. You know, if you find yourself over trading a lot, you're not doing as well as you thought,